Good evening, everybody. You might be thinking they missed the presentation. Nope, I was just on the wrong slide. Okay, I'm back at the beginning. Good evening, everyone. Welcome out. We're gonna give it a minute or two. Like always. Sandy, like, are you on the summary slide already? No. No. Most definitely not. But where is everybody? Um, yeah, where is everybody? I'm gonna post this real fast in the copy invite link. I'm gonna put this in Discord in case anyone's trying to get in. Now, boom. Okay. If anyone wants to come, is it overwhelming? The hardcores are here. You got that right. Is it overwhelming? Am I scaring anyone away? Do you guys think? It's a lot. I get it. It's a lot. It's why we record. So you can go back, watch it again, come back, ask questions. Anyways, I'm going to give it one more minute to see if anyone else pops in. I know it's Christmas week, but we said we're going to grind on through the week. It is the festive month of options here. We're going to stick to that plan. Most definitely. Most definitely. Okay, we got one more coming. Let's get them in. As soon as the audio is on, we're going to just dive in at this point. Okay. I'm going to watch for the audio to be heard, and then I'm done. All right. Officially welcome out everyone to the Market Watch Group Options Foundations course. Today we are talking about time spreads. Time spreads. Very exciting time spreads. I like them. Particularly now, I love calendar spreads. Good evening to you, Stephen. I'll even show you one that I put on not too long ago, so you can kind of get a sense of what it looks like, what it's all about. So yeah, we will definitely make sure we go through that. All right, let's dive right in. Here are the disclaimers. This is the standard. Here is today's agenda. What are we going to be talking about? What are we going to be doing? We're going to start with what they are. What are time spreads? What do I mean by that? You'll understand that there are a couple of types. We're focusing on calendar spreads. We're going to go through the details of calendar spreads. We'll talk about the advantages and the disadvantages. We're going to talk about diagonal spreads. We're going to talk about what makes them different. How do they fit into our overall plan? We'll talk about the advantages and disadvantages of diagonal spreads. Little bit of a discussion on determining strike prices. What are the thoughts as to not just strikes, but also expirations, because we have offsetting expirations. So I should throw that in there, and we'll make sure we touch on that in that slide. We'll talk about some tips for success. How do we do better with time spreads? And we'll talk about pitfalls to avoid, summarize it, move on. I can't believe we are on session 6 of 8 already. I cannot believe that Christmas is in 4 days. Very exciting. Love Christmas. Can't wait to have it with my family. All right, let's dive in. Please throw questions at me along the way. And that way, when I don't give you more than a minute or two at the end, we will know that our questions have already been answered. So that will be very useful to me. Sandra says, we want more. I love it. Sandy, your commitment and good attitude are phenomenal. I just wanted to call that out. What are time spreads? Let's start here. Definitionally, time spreads, also sometimes known as horizontal or calendar spreads, but also diagonal. So some people don't put the diagonal. The diagonal is a directional time spread. That's got to be recognized. A directional time spread. In fact, building on something we've already done, a diagonal spread is actually quite similar as an option strategy to a covered call. So if you thought to yourself, Scott, I like covered calls, I just don't know that I have the assets to drop buying 100 shares of stock at a time right now. Fine. Instead of buying 100 shares of stock, buy one deeper in the money, further out in time contract that will behave somewhat similar to the stock. Maybe at 80% of the stock, but at 20% of the cost, 15% of the cost, right? And then we sell covered calls against that underlying option position, as opposed to selling calls against the underlying stock position, like we did with covered calls. Some people call diagonal spreads covered calls on steroids, right? That's because it's leveraged. It involves the simultaneous purchase and sale of options. And I would have to correct this. For a calendar spread, same strike, different expiration. For a diagonal spread, different strikes, different expirations. But overall, what are we doing with time spreads? We're capitalizing on time decay, leveraging the rates at which options will lose value over time, particularly in a low implied volatility environment. That's important because I'll hear people all the time. Oh, I sell premium. I sell premium. I do credit. Oh, is that what you do when premium is cheap? You sell cheap premiums? I don't. I don't see the point of it. Why am I selling cheap premiums? The market makers are saying, we need buyers. So either I come in as a buyer or I come in a different Vega positive strategy. That's what makes these. So next week we're going to talk about butterflies and iron condors. And some people are like, well, isn't that a time spread too? In the fact that they profit from time decay, yes, but they're more complex. They're 3 legs and 4 legs, whereas these are 2 legs. But those are more complex because those are more used in a high volatility environment. The ones we're talking about now are more conducive to the market we're in because they benefit when implied volatility is low. That's the difference. We use them to benefit from time decay while managing risk and cost. What are the types of time spreads we're dealing with? Calendar spreads and diagonal spreads. Calendar, also known as horizontal. Think horizontal, sideways. Same strike price, different expiration. They expand across time. Diagonal is exactly that. Different strikes, different expirations, which gives it more of a diagonal feel, right? More of a diagonal look and feel. The importance of neutral, which are more calendar, and bullishly directional time spreads. You'll notice I don't have bearish time spreads on here. Why not? Because stocks walk up stairs and fall out windows. Walk up stairs, fall out windows. There's not a lot of benefit to trying to take advantage of time. That's not what you're benefiting from in a bearish market, right? So that's why I'm only in a bear market. We're going to have a very different set of circumstances and strategies. So this is a possible strategy when the market is flat. Correct. Correct. And not even necessarily just flat. We're pretty bullish right now. I'm doing time spreads in a leapfrog fashion to my directional trading. Do I want to buy calls and put calendar spreads on? No. When the market's at support, I'm buying calls. When the market ramps up and gets to resistance and starts to, fall victim to buyer fatigue, starts to hit a resistance point, I'm exiting my directional bullish trades and entering calendar spreads. Because if the market's going to pull back and then kind of go sideways and then rally again, I can make money during that week or two, right? I can make money, and I'll show you how that's possible. So in a straight up sideways market, yes, absolutely, right? If we have a really bullish market in 2024, there's a great chance that 2025 and 6 are very sideways. Back in 2002, we finished up a bear market like we did in 2022. And in 2003, it was very bullish. Now, this year was kind of bullish, but not very bullish. But in 2004 and 5, we had a lot of sideways, and traders really struggled during that market. As options traders, we don't need to. This absolutely expands our ability to trade in various market conditions. And if you're going to take the time to really understand the conditions of the market, which we do, we want to make sure we're ready to capitalize. Okay, what's the importance then? Neutral time spreads can be employed when we anticipate minimal price movement. Bullish directional time spreads can be used in a situation where we expect bullishness, but also that implied volatility is low and we're trying to take advantage of being in a trade for longer periods of time. We want to benefit from both time decay and upward price movement, which is exactly what I know. I'll throw his name out because I know he does this, which is exactly what Stephen is trying to capitalize on with covered calls. I want to benefit from owning the underlying stock and benefit from selling short-term premium against it. With the diagonal spread, I want to benefit from owning the underlying option, the long option, but then also benefit from selling short-term premium against the position that I'm in. So with low volatility means cheaper than usual. Yes, low volatility definitely is cheap. Not necessarily than usual, but than historically seen, right? So when we look at the last year and we're like, this is low volatility, usual is more of a median, right? A mean, something in the middle. This isn't even in the middle. This is cheap, and we want to be buyers. Great observation. Okay, let's dive into specifically calendar spreads. What are we doing here? This involves options using the same strike price but different expiration dates. It's a neutral strategy combining short-term and long-term options, selling the short-term, buying the long-term. Why? Because short-term options decay at a faster rate. The cliff, right? It's very, very slow. Let me just draw this real quickly. Yeah. So this is how options decay slowly, and then they start to fall off. So we're buying this option and selling this option. Over the next 2 weeks, this is going to slowly decay. This is going to rapidly decay. So this is going to create a theta positive environment, if that makes sense, right? Theta positive environment. But they are bought at the same time. Correct. We enter at the same time. Okay. So you're saying we would sell the short-term one before the long-term date. Yes, different dates. So we're going to sell, for example, when I do calendar spreads, 2 weeks, 4 weeks, right? 2 weeks, 4 weeks. I sell 2 weeks out. I buy 4 weeks out. Okay, let's keep going. Make sure you understand why we're doing this. Erase. Clear all drawings. Okay. So this is designed for stability, capitalizing on time decay with minimal dependence on big price movements. Right? So let's construct it. Choose the underlying asset. Opt for stable stocks to maximize time decay. I opt for index ETFs. I will do these on SPY. I will do these on QQQ. I will do these on IWM. I will do these on DIA. I like the ETFs. There's no earnings. They're more stable because they're balanced. I don't like doing these on individual stocks, although some people do. And you can be successful with it. That's just my personal preference. We select different expiration dates. We stagger short and long term to exploit time decay and exploit volatility. And we maintain neutral by selecting strikes that are identical and close to the money. You can directionally bias these, but why? Right? I don't want more than a little bit of a directional bias. I can build it a little above or a little below where I am now. But for the most part, this is not about price movement. This is about time decay. Monitoring. We stay vigilant as options lose over time, trying to inform our decisions. Now, here's the thing. When I do a calendar spread, I will add one. I'm not going to stop out. Sandy said, do we need to watch carefully or have stops? Watch carefully, because in the beginning, I'm not going to stop. I'm not going to be like, oh, that's going wrong. It can't go wrong. If it goes up, I can put another one up above it. If it goes down, I can put another one below it. So I can make the adjustment. I'll show you what I mean here in just a minute. I can roll the position. I don't tend to do that. If someone were to go 2 months out in time and sell 2 weeks, they could sell 2 weeks and then another 2 weeks and then another 2 weeks and another 2 weeks, and they can roll the options. My preference is to put a trade on this week and then a different trade the next week and then a different trade the next week. And I'm both putting new trades on and managing them like an inventory, because again, these are not price movement dependent, right? I can just put it on, add to it, take it off. Do I sometimes have to take a loss? Of course I do. This isn't magic. It's pretty good though. The last time I did calendar spreads was in the year 2019. Why not since then? Because we have not had implied volatility below 15 since this year. And we haven't got below 12 since the last month. And that's where I want the implied volatility to be for this. In 2019, I had a stretch of 14 weeks in a row, profitable calendar spreads, like writing checks almost. Steven said, not had much success with rolling the trade. I agree with sequential. Yes, I would rather stack them, rack them and stack them, put the next week on. If it starts to go wrong, I'll adjust it. Will I sometimes have 3 different trades going simultaneously? Yes, it tends to be only 2, but I'm willing to have 3 because they're not that hard to manage. Don't be like, oh, it's so many trades. It's not. It's not. I put a trade on a week ago. I literally take a look at it for a minute. I'm like, hasn't done anything yet. So I don't tend to roll. I tend to close the spread. Do I buy in advance? No. Let's go look. Let's go see this to understand it better. Okay, so this is the risk profile of a calendar spread, right? Remember, this is my 0 line. So anything above this is profitable. Right now, I'm profitable between 463 and about 479. 463 to 479. Okay, so let's look at that. 479 is up here. For me to start losing money, it would have to pop up here to 480. And if it did, I wouldn't take a loss. I would put another trade on. I'd just put another trade on and let it, because I think, it might hit that and then start to come back down. And I'm profitable down here to 463. So this range, and how long do I need? I only need to get through tomorrow. All I have to do is get through tomorrow. I'll show you what I mean here in just a minute. Yeah. where these time decay trades really, really, really work out. So my assumption is it's going to stay somewhere between right now 463 and 479. If it got up to 480, I could change it so that it's good from 468 to 488, 485, right? So I can adjust it up or I can adjust it down as necessary. When did I put this trade on? I put this trade on, let me just see. I did this one as an example. As an example, let's go margin. Let's go 30 days back. Let's look at the history. I put this on 12/15. 12/15. That was here. Why? Because it got up here to resistance and then started to poke back down. I actually could have put it on here. And I probably would be a little better off because I would have been a little higher with my strike, but I'm fine. That's the point. I don't have to try to be perfect with my entries. I'm a day late, so what? That's why we do these trades. That's one of the advantages of these trades. Okay, so I put it on here and it went up a little bit. Did it go up enough that I had to adjust it? Nope. And then it dropped and then it moved up again today. Am I having to do anything? No. Now let me show you this. This is where it gets good. Okay. So as of today, 12/21, my delta is very close to neutral, -18, which means what? It means the sweet spot's right here. If it was down here, the delta would be positive, which means I want it to go up. This delta is telling me which way does this stock need to go to move this to the sweet spot, the highest point of this purple line, right? That's where we are today. The green line is at expiration. I have no thoughts that I'm going to be there for expiration. That's not how this trade works. This trade is about probability. It's not about trying to make as much money as I possibly can. Don't be greedy. Now, what happens tomorrow? Let's push this one day. Bing, now it's 12/22. Right now, it's making about 340 bucks. The next day, it says I'm actually only still making 330. But then what? Then we get Saturday, the 23rd. Bing, now I'm making 360. Then I get Sunday, the 24th. Bing, now I'm making 400. Then I get the 25th. No markets open then. Now I'm making 440. Then I get to the 26th, and now I'm making almost $500. Almost 500. How much did this trade cost? About $11.50. Right? About $11.50. 500 bucks. Is that good? Honestly, if I make 20 to 25%, I'm willing to just bail. Why am I not doing it now? Because it's in such a great place. So what will happen is come Tuesday, I'm gonna shut this down. Right? I'm gonna shut this down. What are my dates? January 5th, January 19th. January 5th, January 19th. Now, if I were to do another one of these, I'm on a calendar spread here. January 5th is 14 days. Technically, I could actually do another one of these at the same, I could start another one of these right now at the same level, right? In fact, you know what? Maybe we could do that. Let's see if I can do that. Let's do one right now. We're going to analyze. We're going to change this back to buy. But I'm going to change my strikes. Right now, these strikes are 470. Where do I want to be? I want to be a little bit more like, let's say 475. I want to be up in here so that that trade can actually exist for another couple of weeks. So I'm going to try to put this on so that we can manage it, and we'll look at it during our class, right? We'll look at it during our class. So if I were to do that right now, this says it would be about a $1.35. This one was only a $1.18. It's a little more expensive. Why is it a little more expensive? Because from the 15th until now, let's look at the VIX. From the 15th, on the 15th, the implied volatility was 12.35. Now, where is it? 13. it means it's a little more expensive. It's going to cost me a little bit more. But I want you to notice that this is a Vega positive strategy. Vega positive, which means what? It means if volatility goes up, I make money. When does volatility go up? When the market goes down. So this actually gives me a bit of a hedge against a drop. You might think, oh, if this thing drops, you might be in trouble. No, if it drops and volatility rises, I will actually be okay. It'll help sustain the trade and allow me to manage it and not panic that something is happening. One thing I will tell you, if you practice these, you're going to realize they are much smoother, much easier to manage and keep an eye on than directional trades. So if I put this, now if we put one on Friday, my intention is to manage it all next week and close the week after. Manage for one, close the next. Manage for one, close the next. Now, why am I carrying the one I have to the following week? Because I went a little further out in time and because it's in a sweet spot. It's gone perfectly for 5 straight days, and now it'll be very difficult for me to lose money on that trade. Right? I'm not going to say, oh, I'm guaranteed to make money. Of course I'm not. I think I have a very good chance of booking between $400 and $500 on that trade, which puts me making between 36 and 40% approximately on a trade that I really didn't do anything for. I just sort of said, hey, you know what? I'm in the process of closing my bullish trades. This thing's hitting resistance. Let's put one on. If it went up a little bit more, I'd put another one on. And if it went up a little more, then maybe I'd have to take my loss and move on. But I expect to be right on these trades 70 to 80% of the time. And even when I'm wrong, they're not bad losses. I'm expecting an average reward to risk of 1-to-1. So if I can be right 80% of the time, winning 1 every time, sometimes getting 2, and then when I'm wrong, only losing 1, it's a great expectancy. I do look at this as a different system. This is not the same system. This isn't a swing trade. This is a time spread, right? Okay, let me know if you have any questions about that. I'm going to have to just keep flying, but we're trying to put this trade up. I'm going to go ahead and confirm and send. We'll see if that fills. We'll talk about it tomorrow. Those who weren't there, this will give them incentive to go back into the recordings and catch up. All right. That's calendar spreads. Real quickly, what are the advantages and disadvantages? The advantage is it involves minimal investment. It's low cost. There's limited risk. You can't lose more than you put in, and you rarely even risk anywhere near that. The another advantage is it works extremely well. It works extremely well in a low implied volatility environment. Question came in. Press says, when you say straight directional trade, you mean a straight call or put? Absolutely right. Absolutely right. Disadvantages. Limited profit potential. You're not going to knock it out of the park. You're not hitting home runs here. Yeah, which is fine, right? That's not what it's about. They offer low risk exposure. The potential profit is also limited. I'm like I said, 1-to-1. That's all I need. But it's steady. It's steady. It's consistent. That's what we're looking for here, right? I think we've all gotten to the point where we're like, yeah, I'm not looking to smash home runs. Then I'm more likely to strike out. I'm looking to be as consistent as I possibly can. It's very sensitive to shifts in implied volatility. Volatility going up, great. It's built for that. Volatility going down, it will smash you. That is the fatal flaw, is if implied volatility drops. So if implied volatility dropping is the fatal flaw, what do we want from implied volatility? Start low. Start low so there's no expectation that it's going to drop. Yeah? That's the thought process. Okay, bam. 1 down, 1 to go. Diagonal spreads. Definitions and characteristics. Diagonal spread integrates options where the strike prices and the expiration dates are different, which provides a very nuanced approach to trading. Like I said, covered calls, but better because I have leverage. Bullish directional strategy. Diagonal spreads are crafted with a bullish bias. We're anticipating the stock to go up, right? To go up. Construction. First, choose the underlying asset. I will do diagonal spreads on individual stocks, more so than I would calendars. Calendars are very specifically, in my opinion, built for the indices. But if you start to see the market start slowing into a steady trend and things are starting to take 10, 12 days, this is a great way to put a trade on that you're thinking, hey, even though implied volatility is low, and I'm very tempted to always buy the option, when you start seeing 10, 12, 14-day moves, you start realizing that it's sucking the life out of your option, that time decay. So this provides an alternative in that very specific scenario. Selecting expiration dates and strike prices. Remember, again, different expiration and different strikes. How do we manage them? As always, monitoring closely price movement. Right? So we want it to move. Sometimes we may have the ability to adjust or roll the spread. Sometimes we just simply have to close the position to realize the gains or limit the losses based on our objectives and possibly changing market conditions. Okay. What are the advantages? You have a higher potential for returns. Right? You can benefit more with the option that you own when it goes the right way. They have flexibility and adjustment. We can roll it. We can close it. We can close just the short option and let the long option run. We have flexibility. Once again, benefiting from a beginning low implied volatility point. One of the things I'm going to put into the next round, and maybe I'll even create the slides and share them so you can see it, is like a matrix, right? If my market posture is blank and the implied volatility is blank, these are the strategies that make sense. And really, we're going to have, I would say, I guess you could really have like 15 potential. We have bullish, slightly bullish, neutral, slightly bearish, bearish. And then we would have low, medium, high volatility. Really, it's low and not low for me. So maybe 10 scenarios. I'm going to work on that. I think that would be helpful. Is there any situation where you benefit when your options expire? Yeah. In a calendar spread, remember that you sold a short-term option. So if you get to expiration, and the option that you sold is out of the money, you can let it expire and keep the long option. And you can either sit on the long option to see if it keeps going the right way, or you could sell another short option. Like I said, a lot of flexibility. But it's not like a credit spread where you get 100% gain when it expires worthless. That's a little bit different. What are the disadvantages? Higher costs compared to calendar spreads, right? You're buying a deeper in the money, further out in time option. So it's going to cost you a little bit. They're a little bit more intricate to manage because you have different strikes, different expirations. You may need to roll, etc. So this is definitely one when a pricing model would be very, very useful to you. Let's stop for just a second. I'm going to build one. Real quickly, though, let's find a bullish trade that we like the signal on. Let me move this over here. I love your questions. I hope this is making sense. I know it's a lot. Apple, Apple, you son of a gun. Okay, let's see what we like. APH looks pretty good. Applied volatility is low. There's a possibility. BK, BLDR, both of those Although BLDR has a little higher starting point volatility, so I might be more inclined to bull call spread that. A lot of things setting up, a lot of things starting to fire signals. I saw press put anyone considering any trades, and I didn't have a chance to put in. I'm assuming somewhere BX on the table. I would say a lot of things on the table, not necessarily triggering yet. Costco on the table, CrowdStrike on the table, Delta Airlines on the table. Look at that high vol though. That's definitely one I don't want to buy expensive options on right there. That's one I want to be doing credit or debit spreads on. Yeah. DHI, maybe. ENVX getting close. A lot of things are setting up. Gap never died, but it hasn't moved. Oh, I mean, come on. If IBM signals tomorrow, you guys have to be like, Scott, that was amazing. You nailed that. Where you put that line, how you put that line. Thank you, Press. Press is loving it. Come on. Look at it, just waiting for the trade. Oh, God, I want that so bad. You guys don't even know how bad I want that trade tomorrow. ICE looks okay. Intel. Oh, Intel, son of a gun. Got back up a little bit. I'm not in it. Nothing really there, though. JP Morgan's a freight train still. KKR setting up. Meta. Woohoo. Meta kept going. I'll be done tomorrow. That's it. I'm running out of time. But that was massive. That was a great one. I only had a third for the last little bit, but that third really is making the trade, you guys, right? Microsoft just won't get going. Netflix, I want the next one. Same with NVIDIA. Getting close, setting up again. Overextended, maybe setting up. Maybe it's going to give us a signal. I'd say PNC is on the table. Okay, you know what? I'm taking too much time on that. Let's go back. I'm going to go APH. I'm going to go APH. I'm going to go, let's maybe go 95 to buy, and I'll go a month or two out, and then I'll sell the 100. Okay, so let's go from calendar to diagonal. I think I'm still gonna. I'm just gonna try. Well, let's go to Febs. Let's go to Febs. I'm gonna go. No. What have I done? I'm gonna go here to February 16. And we said 470. I need more strikes. 470. Nope. That's the wrong stock. Sorry. That's my bad. APH. Oh, never mind. Well, I don't have time to go back. Let's just put this on so you can see it. 70 by 75. So I'm going to that's not going to work. Oh, I need to have a better example ready. All right, let's just go back to SPY and use that. Let me erase all of this. We'll stay focused here. Risk profile. I'm going to go out, buy these, and I'm going to sell only. Now, right here, it looks like this looks like a calendar spread, right? Why? Because I'm only one strike apart, right? I'm only one strike apart. I'm going to buy these and I'm going to sell these 475s. And what happens? Oh, I start to give this more of a bias to the upside. And you can see it won't lose money, right? And I can start to decide, do I want to maybe even go up to 477 to make it a little bit more bullish? Ah, there we go. Now, this is what a diagonal spread looks like here. If it stays in a range, it behaves kind of like a calendar spread. But if it makes a big move to the upside, which is what we think might happen, it behaves more like a vertical spread. So it's a little bit of a hybrid, the red and the green lines. Purple, this one here, is today or whatever day is in this box. So if I say today, this is the box. Green is expiration. In this case, it's using the, what date is it using? Why can't I even see that date? Looks like it's using the January option. I'm going to actually change this to the 5th to the 19th. So I have one that expires in January and one that expires in February. Right? Let's actually take this a little higher. There we go. Now what happens? Well, if it goes up to 485 and I'm just sitting in it when it gets to January 19th, what can I do? I can lock in my gain and then I can sell January 31st. And then after those 2 weeks, I can lock in the gain and then I can sell February 16th and turn it into a calendar spread. So I have a lot of flexibility with this. You can see what I mean when I say it's much more expensive, right? Significantly more expensive. I'm going to bring it down to 2 contracts. And I'm going to confirm and send this one as well. And we're going to see about putting these on. Now that we're talking these more complex strategies, I want to put these on and show them to you while we're working, while we're in our regular sessions. And that way I can hopefully entice other people to start coming back and watching. I'll be like, hey, if you don't know what we're doing here, go watch the recording. Go watch the recording. That's how those always work. Press. Let me go back to the calendar spread I have on. The purple is today. And as I advance this, it shows me what happens out into the future. So if I keep going, you can see that purple line keeps advancing until what? Until it eventually gets to expiration. And then it's the green line is expiration. So it shows me time decay. When the green line is above the purple line, time decays up. When the green line is below the purple line, it decays against you. So you'll notice your theta positive in this area, it gets to theta negative out in this area. So that helps to show the representation between where we are now and how time is going to impact the trade. Okay, there you go. I like when something connects. That's a great question. Great question. Such an important part of how this model works. It's funny because if someone were to say, hey, Scott, I had people do it all the time. Someone out in the internet creates some weird ass strategy and they're like, sell 3 of these and then buy 1 of here and then buy 2 of these. And it's like, they're like, what does that mean? And I'll come in and I'll build it. And how I know how it works is what I see here. I can see if time is for me or against me. I can see if price has to go up or go down or stay the same. Right? So here, I want price to stay as close to 470 as possible. If it deviates, I have to make an adjustment. Beautiful. Sorry to hear it, Stephen. Definitely go back, watch the recording when you're done. All right. So we've gone through the basics of these strategies. Yeah. Let's just real quickly wrap this up and we'll have these 2 trades that we can be looking at over the next week. Next week on Tuesday, I'm going to introduce you to butterflies and iron condors. And we're going to put a butterfly paper trade on and an iron condor paper trade on. And we're going to start anything that's a little more complex. We're going to start doing some of them on our as a group so that you can see them, understand them. And I'm going to try to integrate that into what we're doing a little bit more. So be ready for that. What are the determining strike prices? What should we be thinking about? What's the implied volatility? Right? What's the implied volatility? What's your outlook? Are you more bearish or bullish? More bearish? More neutral? Remember, if you're bearish, I'm going to say there's a better strategy than a time spread. So can you do it? Sure. Is there a better way? Absolutely. Risk tolerance can help. but mostly I want to evaluate my reward and my risk. Where am I wrong? Where am I going to have to make an adjustment? How much risk do I take when it gets there versus how much reward will I get? And I think you'll see over time that you get a better sense for each of these. Tips for success. Number one, continuous monitoring. Like we always do, monitor news, monitor indicators, events, keep an eye on your posture, monitor your position, make sure that it's doing what you thought, that no adjustments are necessary. Risk management, predefine your risk tolerance and your limits in order to protect the capital and to diversify. I don't need to put a bunch on one trade on SPY. I can start one today, add another, start one next week. I can start one on the Russell if I need to. I can move around to the different things, but these are a great balancing trade, right? A great balancing trade with directional trading in a bull market. As always, regularly assessing market conditions. That's how we live. It's the name of our group, Market Watch Group. All we do is assess conditions. Conditions are everything. Context is everything. Pitfalls to avoid. Neglecting time decay. Not understanding how it's going to work and how it's going to potentially benefit or work against you. If that calendar moves too far, you're no longer getting time decay. The trade has changed. You need to adjust. Neglecting implied volatility is another one. If the if you get in high volatility and it drops, you're going to have a very hard time making money. A very hard time making money. Ignoring trends. Don't let the market shift without making an adjustment. Overlooking adjustment opportunities. When it's time to adjust because market has changed, adjust. You can salvage the trade by adding another piece. I can promise you that. And failing to close positions at the right time, knowing when to cut losses or take profits. We need to have clearly defined exit strategies in place. Know in the first week, where and when would you adjust? I'm not going to take a loss in the first week. I'm going to adjust it. In the second week, then I'll take a loss if I have to. And you'll see that over time as we go through these strategies in greater detail. Quick summary. I'm already 4 minutes into your time. Remember that calendar spreads are neutral strategy leveraging low volatility and time decay. Diagonal spreads more of a directional approach, combining the best of debit spreads and calendar spreads into one trade. Love that. Make sure that you are aligning with market conditions. Don't put the wrong strategy on at the wrong time. I think the Chinese said it best, an old Chinese proverb that says, do not attempt to remove a fly from your friend's forehead with an axe. Makes sense. Press said yesterday was spontaneous change in the market, a little bit of a panic. And maybe not necessarily panic, but maybe trying to salvage profits, there's nothing wrong with that, right? Look, I want you to self-assess at the end of that and be like, could I have done it better? And if I could, what would I have done? And how would I have known that? So I want you to look in the mirror. I don't want you to be overly harsh on yourself, right? I mean, look, if you can get some experience from it, amazing. That's how we have to do it. And I tell you, I expect in our group that I'm going to have to really caution people against being too harsh more than I'm going to have to recommend that you guys look inward. Everyone seems very willing to do that in our group, and I love that about our mindset. Sandy put some phenomenal comments about the Market Wizards books. She picked up on all the right things. You're not there to think, oh, they're going to tell me what indicator they used. Doesn't matter what indicator they use. You'll use it differently. You're there to learn the key integral parts of like what led to their success. Where did they hit speed bumps? How did they overcome those obstacles? And you'll realize it's rooted in psychology. It's rooted in risk management. It's rooted in consistency and discipline and organization and structure. Love it. Continuous learning and adaptation. Stay informed. We know this. Market's evolving. We're evolving. Flexibility is a key. Adapt or die. Be water, my friends. Whew. Okay. Thank you, Press. I hope so. It's been a lot of years I've been doing this, man. Okay, I'm going to tell you guys a story. I'm going to tell you a story, and you're going to laugh, but don't judge me. I literally one time was on a session and I dozed off, and one of my kids walked in, and the person asked me a question and I answered it. And my kid was like, what did you say? What was right? And I'm like, I did. And they're like, are you saying you literally did that in your sleep? And I'm like, yes, but I was sick at the time. I was fighting something off. I dozed off. It's not something that regularly happens, but yes, I've done it in my sleep. Um, I love it. I love this. I see you guys love this. I understand why you love this. And we're all in it together. So, unconsciously competent, that's what we're looking for, right? Unconscious competence is the goal. Thank you, Sandy. I really enjoy having you. You guys with the right attitude, it makes all the difference. That's one of the reasons I love this group. Is every single person. And I had somebody, this is crazy. I a little bit kind of kicked somebody out. Somebody came on one time and started like putting weird comments. And I'm like, what is going on? It really threw me off. And I'm like, yeah, we can't have that person in our group. And I told them to refund his money and pop him out. Not going to do it. Absolutely unacceptable for me. I love what we have. And I love that you guys are working together collaboratively in the group, in the Discord. I appreciate that. I hope to be able to continue to contribute there as well. I feel like we got the questions answered, but if you have any extras, let me know. Otherwise, Merry Christmas to all. Stay safe, and yes, we're meeting tomorrow afternoon, and we are meeting Christmas Eve, right? We are meeting Christmas Eve. Absolutely. We are going to meet, and then I'm going to head out, pick up some breadsticks from Olive Garden for soup later that night, pick up some chocolate croissants for Christmas morning. We will be here. Thanks, everybody. I'm definitely going to put out a survey when we're done with the options, because I really want to. I think the first pass is great. I think the second pass is going to be much better. So I'm looking forward to adapting what we do the second time around. Have a wonderful night. I'll see you tomorrow afternoon. As always, happy trading, and same to you, Press.